This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In Chapter 16, we got introduced to the structure and the content of the corporation tax computation. What we also saw were three definitions that underpinned all the work that we do in corporate tax. Now, those three definitions were of period of account, accounting period, and financial year. The first two of those being the most important. The period of account was simply the period for which the company had prepared its accounts, i.e. its statement of profit or loss. Basically, in terms of any Section C question in which you see this particular issue, the question gives you the statement of profit or loss, the period of account. Now, the period of account, as we learned, would usually be, and the vast majority of questions you'll ever see on a corporate tax computation, will be the company's normal accounting year end. So what will happen is the period of account is an accounting year. The period of account then becomes the accounting period, the accounting year end, whatever that may be. And it is the accounting period that is critical because that's your answer. The period of account was the statement of profit or loss. That was the information in the question. But our answer demands the preparation of a corporate tax computation. And the corporate tax computation is prepared for an accounting period. Those two are usually the same. The period of account is normally the same as the accounting period. All you've got to do is take that statement of profit or loss and adjust it to make it acceptable for tax purposes. Where does most of that work lie? As it did back with an unincorporated trader, adjusting up your trading income assessment. But we also saw on that corporate tax computation there were two other sources of taxable income that we might have as a company, they being property income and interest income. We didn't see dividend income as part of our total profits nor taxable total profits because dividend income, for companies at least, is exempt as a source of income. For you or I as individuals, of course, it is included on an income tax computation. But on a corporate tax computation, no, it's not a part of either total profits or taxable total profits. We also had not just income but capital gains going in as part of the total profit, and from total profit we would then deduct the qualifying charitable donations to give us TTP, taxable total profit, the figure that was then charged to tax. At that point, the third definition of financial year came into play. Not that really it ought now to be an issue, as we've seen both the current and the previous two financial years, FY19, FY18, FY17, all bearing the same single corporate tax rate of 19%. As we saw, we had to go back as far as FY16 to see a tax rate other than 19%. And the chances of having an accounting period straddling those two financial years is pretty remote. The technique, however, is still there. We need to know what to do. It was a simple time apportionment exercise. Now, the starting point, as we said, in the question was the company's period of account. And as long as that period of account was either 12 months, your normal year end, or even less than 12 months, we didn't have a problem, because the period of account would indeed become the chargeable accounting period. We define that accounting period as being, of course, the period for which the corporate tax computation was prepared. It would normally be the same as the period of account, but it cannot exceed 12 months. And we said, and hence the purpose of this small, thankfully very small chapter, we said if there was a long period of account, one of more than 12 months, given that a corporate tax comp could not exceed 12 months, then there was a need to break up that one period of account into two corporate tax computations. And it would always be that the first of those two computations would be for 12 months, and the second would be the balance of months. If we had an 18-month period of account, the two corporate tax computations to prepare would be for the first 12 months of those 18 months, and the second computation for the last 6 of those 18 months. So now in Chapter 17, we see how it is we take one statement of profit or loss for one period of account, and from it we now prepare two corporate tax computations. Hopefully, given the work you've already done, subject to not yet knowing how to compute chargeable gains for companies. But you should know how, based on a period of account of 12 months or less, we can go about preparing just the one corporate tax computation required. But what do we do? How do we do it? When we take that single period of account and then, because it is long, more than 12 months, we need to divide it between the two corporate tax computations, the 12-month period and whatever the balancing amount of months for that second period would be. How do we do it? Our rules here in Chapter 17, as we look now at our notes, as to how we apportion any income and expenditure. As we've said, if a company has a period of account longer than 12 months, we split it into two accounting periods, the first 12 months and whatever then was the remaining months. So we now look at the income and expenditure that would be of the period of account and how that is to be divided between the accounting periods as follows. Right, what we do, we know that the main figure is the adjusted trading profit, and the adjustment of profit exercise is done for the period of account, the statement of profit or loss, whether it was as before 12 months or 9 months, and now it may be 15 or 18 months. Whatever it is, you do a single adjustment of profit to get an adjusted profit figure. But that is an adjusted profit before the deduction of capital allowances. So you take your accounting profit as you normally would, you add back the non-allowable expenses, you take out any sources of income or indeed gains, which are clearly not therefore income and cannot be trading income, to derive what would be the trading income figure, adjusted through the adjustment of profit process, but prior to deduction of the capital allowances. So the period of account, the statement of profit or loss, as normal. The length of it is irrelevant as regards the process. Start with the accounting profit for the 15 months, the 18-month period. Add back your non-allowable expenses, take out any income that is not trading, take out any capital gains, and get your trading income figure. Now that figure is, of course, on this occasion, for a long period. It may be, as we said, an 18-month period. So how do we now split that between the two accounting periods? Well, very simple. It would be time apportioned. So you've got your adjusted profit for an 18-month period. So you take 12/18 and 6/18 there into your two separate corporate tax computations, your two accounting periods. Now, the way that we'll show this, as we'll see soon, is that we would have two columns on the right-hand side of our page. If, of course, we were presenting this as a response to a Section C question, a written question with a written answer, we're going to have the two accounting periods identified on the right-hand side of the page in two columns, 12 months to, and if it was an 18-month period of account, 6 months to. Always 12 months for the first one, then whatever the remaining months of the long period of account as the second accounting period. So here, adjust up the profit for the period of account, the statement of profit or loss, and then time apportion that figure between your two accounting periods. We did that prior to the deduction of capital allowances, because for capital allowance purposes, we have separate computations for each accounting period. We do not prepare a capital allowances computation for a period of account. We prepare capital allowance computations for accounting periods. We would now have two accounting periods in this example, a 12-month accounting period followed by a 6-month accounting period. Therefore, two separate capital allowance computations are prepared. The first for the 12-month period. Now, as we said, if anything, in terms of capital allowances computations for companies, they're easier than when dealing with individuals and unincorporated trades. Why? There's no private use issue. So it simply is looking at the types of expenditure incurred during each of the 12-month period and the 6-month period, looking at any disposals in each of the 12-month and the 6-month period, and doing two separate computations. So we'd have a tax written down value brought forward at the end of the previous accounting period prior to this long 18-month period of account. We set up the first capital allowance computation, the 12 months too, pick up the tax written down value brought forward, and then do as we've always done. List out those additions that rank for AIA and take the AIA. It's unlikely that the amount of expenditure qualifying will exceed £1 million, our annual limit there, and therefore all such expenditure qualifying is likely to rank for AIA. If for whatever reason the amount of expenditure exceeded 1 million, then of course we would have the balance of that going to any relevant pool. And the same issues as we looked at in Chapter 5 apply in terms of applying AIA expenditure, firstly to expenditure that would be incurred in relation to special rate pool expenditure, and then to main pool. So the worst that happens is you limit the AIA to 1 million and the balance goes into the relevant pool, probably a main pool there. Now, of course, as long as you've got that figure going into your main pool, it will join up with any tax written down value brought forward on the main pool, and of course you may have a special rate pool as well. But having got now the AIA expenditure properly dealt with, we then move to expenditure that does not rank for AIA, but does rank for writing down allowance. And that, of course, was most cars, other than the low emission cars that we saw, because they come in at the very end. And at the very end of the computation is where you deal with first year allowance. But again, AIA expenditure, cars other than low emission, so WDA expenditure, because we do not have AIA on cars, and we then take the relevant WDA, depending again on whether or not these cars go into main pool or special rate pool there, again, depending upon the CO2 emissions. Take out any disposals, of course, from any of those pools, be it main or be it special rate. And on that remaining balance, calculate your WDA. Now, because this is a 12-month accounting period, the AIA available was a full 1 million, the annual limit. And of course, your WDA is your full annual limit, whether that be in relation to your main pool or your special rate pool. If there was any low emission cars bought during that 12-month period, list them, take your FYA. Then carry forward your tax written down values on any main pool and or special rate pool to the next accounting period. How long will it be? 6 months. It's the same order of dealing with transactions. Additions for AIA, additions for WDA, take out disposals, claim your WDA. List then any low emission cars ranking for FYA. But what we've now, of course, got to realise is that we're dealing with a short period. It is only 6 months. The AIA limit of £1 million is based on a 12-month period. Therefore, if this is only a 6-month period, the maximum is going to be 6/12 of 1 million, i.e. £500,000. When you come to your WDA calculations, those writing down allowances are per annum. Therefore, as this is a 6-month accounting period, we'll only be able to claim 6/12, 6 months worth of the annual writing down allowances. Only that amount will be claimable. Remember, of course, though, if you then do have a low emission car, and if you have one, it's probably likely to be in this short accounting period. Remember, you do not time apportion the FYA. Doesn't matter how long the accounting period may be, for first year allowance purposes, if you bought a low emission car in whether it was a 12-month or a 6-month or a 3-month or whatever period it might be, you get the full 100% first year allowance. It is never time apportioned. Again, all rules that we know, or should know, that is, might I say, from Chapter 5. Okay, so we do two separate cap allowance computations. As they said, both WDA and AIA will be restricted in the second short period, but first year allowances on motor cars, of course, the low emission, not more than 50 grams per kilometre of CO2 emissions there, are never restricted for a short accounting period. Take your capital allowances away from your adjusted profit figure, and you've now got your tax-adjusted trading profit for each accounting period. In those two columns of ours there, we've got the figures. We then look to see whether any other sources of taxable income have arisen. Now, the only two other forms of taxable income are property income and interest income, both of which we work on an accruals basis. The property income accrued, that is the property income less the allowable expenses incurred in each accounting period. So you'd look at the first 12 months, you'd look at the second accounting period. For us, on an 18-month period, a 6-month period would remain. We then look at the interest income, again on an interest receivable basis. But remember, be careful, our non-trading loan relationship rules, NTLR, non-trading loan relationship rules, said that in an accounting period, we do not just include as part of the interest income assessment interest receivable. If we have interest payable on non-trading loans, remember what the non-trading loans were. If you can't, go back and look at Chapter 16 notes where we dealt with this. Any interest payable on non-trading loans would be deducted in determining your interest income assessment. So you did not deduct interest payable on non-trading loans in your trading income calculation, nor indeed in your property income calculation, because you may remember that probably the most likely form of non-trading loan would be borrowing to purchase or improve an rental property there. Then that interest payable is not treated as a deduction against the property income, but instead is treated as a deduction against interest income. Because it's an odd and very special rule, it's just the sort of thing that gets examined, of course. Make sure you know it. So there, you're told the information about property income and interest income. You just do two exercises. What would be the amount of property income accrued for the 12-month period? What would be the accrued figure for the 6-month period? Sometimes they don't allow you to work any accrual at the end of the 12-month period. So all you can do is to work an accrued figure for the entire period of account. If that were the case, then get your 18-month period. What is the accrued amount of net rental income for the period? And then time apportion it, i.e. you just assume that it accrues evenly. And therefore you take 12/18 and 6/18. But if you had the capacity to determine an accrual after 12 months within this 18-month period, and then the accrual after 18 months, then you split into 12-month and 6-month periods and deal with them separately, just as they are separate corporate tax computations. What was the property income accrued in the 12-month period? What was the property income accrued in the 6-month period? And the same idea in relation to interest receivable. Of course, when it comes to having got at that point all of your sources of taxable income, we also have chargeable gains to include. Now, there we will be given dates of disposal, and you're going to allocate those gains based on the date of disposal. So which assets, if any, were disposed of in the 12-month period? Which assets, if any, were disposed of in the 6-month period? And you will allocate now those particular disposals to their respective accounting period. Did the disposal take place in the 12-month period, or did it take place in the 6-month period? You allocate those gains accordingly. Once again, how we calculate those gains in corporate tax, that awaits us in a later chapter. Having included your income and gains, you have total profits. But away from total profits, we deduct qualifying charitable donations. But the basis of that deduction, the date of payment. Only when they are actually paid may they be deducted. So again, allocate what payments were actually made in the 12-month period, if any, what payments, if any, were made in the second 6-month period. Allocate to the relevant corporate tax computation, the relevant accounting period. Now, when you've deducted those donations, you've now got TTP for each accounting period. Now, it may be that there is dividend income, and because dividend income is exempt, it has been and should be ignored up to this point. If you needed to work out when any corporate tax was due to be paid, then that may require you to add in dividend income from non-subsidiaries, non-related 51% group companies to determine a profit figure, to then determine whether the company was large, and then, based on what we'll see in Chapter 23, whether because it is large for one or other of those periods, then whether quarterly instalment payments are required. Now, that probably won't happen. So in which case, the dividend income has simply been exempted in the preparation of the corporate tax computation and TTP, and then it has no other significance. Its only significance is if you've got to work out when you pay the tax, as well as working out how much tax you pay. Because if the profit exceeds the profit limit for an accounting period, then of course we get into the quarterly instalment payment system. How that works, again, Chapter 23. Having mentioned there about the profit limit at 1.5 million, that again, remember, is based on a 12-month period. So if you did need to involve yourself with this exercise, then in that second accounting period of 6 months, you would be time apportioning the profit threshold, the profit limit of 1.5 million, and taking just 6/12 of that. The purpose is then of determining whether the company was large and whether quarterly instalment payments may indeed be due. But that's probably not going to be an issue in our question. We have an example here, an example for you to have a go at. I'll talk you through this now, where the requirement is to calculate the corporation tax liabilities for the relevant accounting periods. And we are dealing with a PLC that's prepared accounts for a 15-month period through to the 30th of June 20. And the results for the period are as follows. So the 15 months to the 30th of June 20. If it's a 15-month period, we know that we're going to split into 2 accounting periods, the first of 12 months, the second of 3 months. The 3 months will be through to that period of account end, the 30th of June 20. So the 12 months would have been through to the 31st of March 20. So define the accounting periods in 2 columns. And what do we then do? We need, first of all, to establish the adjusted profit. It's already been done for us, 4 million. In an exam question, that's where a lot of marks, of course, could be available. Again, testing the whole process of adjustment of profits. What is allowable and what is not allowable as expenses, which income, i.e. trading income, is included, and which income or gains are not. Any gains are excluded. Any property income, any interest income will also be excluded. So we've got the adjusted profit. All you need to do is to split that given the rule that we've just seen between those two periods. We're also told down here about what has happened for capital allowances. So we will be deducting capital allowances, but that is going to require a separate working. We don't need a separate working for the adjusted profit figure of 4 million. We know that we simply time apportion that. It's a 15-month period. I don't think I'm giving too much away. It's therefore 12/15 and 3/15 respectively. But for the capital allowances, they tell you here about the transactions that have occurred, as well as the opening tax written down value brought forward at the beginning of this 12-month accounting period. You've got to allocate the transactions to each of the 12-month period and the 3-month period, and then do two separate computations starting with that first 12-month period. Get your AIA, get the WDA, get any FYA, get any tax written down values carried forward, and carry them forward into the 3-month period. Then proceed to deal with the relevant transactions again there for that 3-month period, but recognising that any AIA is going to have a reduced limit, 3/12 of the annual limit of 1 million. Any WDA, only 3/12 of what is an annual WDA. If there were low emission cars bought, then it wouldn't have an impact. 100% FYA is available. So you'll need to do the capital allowances. We can then see that we've got a chargeable gain or gains, sale of asset on the 6th of May 2020. Gains are allocated based on the date of disposal. So which accounting period do you allocate the gain to? Qualifying charitable donations, allocated again to the relevant accounting period, paid when it's paid, and they're paid annually on the 31st of July. So which 31st of July fell within that particular 15-month period, and which accounting period did that fall into, and allocate accordingly. Once done, you have got your TTP for the accounting period. Once you've got your TTP, you can then proceed to tax at, of course, what will be a 19% rate, irrespective of whichever accounting period you are dealing with. Again here, when you move forward from FY19, what a question will routinely say is for you to assume that FY19 rates or rate continues for future financial years. So that'll be 19%. Okay, over to you guys then to complete that exercise. Once you've made your attempt, then come back and we'll review the answer together to make sure that hopefully you've picked up on all the relevant issues and got it right. Okay, let's see how we've fared here therefore. Now the adjusted profit given to us in a 15-mark section C question, of course, that's where probably most of the work would be involved. We had £4 million, we just time apportion 12 to 3, 12/15, 3/15 respectively. The capital allowances, that's the main part of the exercise here for us to do, as again, no doubt it would also be an important issue in terms of any 15-mark exam question. We'll come to that in a moment's time. The easier things to do, allocate the capital gain, allocate the qualifying charitable donations to the relevant accounting period there, based on the date. The gain was made on the 6th of May 20. May 20, that's in the 3 months to 30th of June 20, hence that gain there. The donations were paid 31st of July, the only 31st of July within the 15-month period of account covered here was July 19. That's a part of the 12 months to March 20 there. So to get these TTPs so that then we can tax at 19% and finish the exercise, there's one missing figure, and that's the capital allowances. So over we go. We know that the first accounting period is the 12 months to March 20, and of course the question had told us that the tax written down value at the start of that period was nil. Presumably, of course, what has happened, we have claimed AIA for everything we previously bought at 100%, and therefore there's no tax written down value remaining. But we bought more plant and machinery during the 15-month period with purchase of new vans. Now, vans, trucks, lorries are treated like any other plant and machinery, and on that basis, therefore, will qualify for AIA. It's 68,000, and that's the 12th of May 19. Well, the 12th of May 19, of course, falls into the 12 months to March 20, so it would be allocated to that particular period's capital allowance computation. 68,000 is a lot less than £1 million, and on that basis we have no problem. It's a full AIA of £68,000. But then the interesting one, on April the 14th of 2020, 277,500. Now, what we've got to realise, of course, here, as we have kept on saying, is that the £1 million AIA limit that we have is an annual limit. This is only a 3-month period. Therefore, we can only have 3/12 of that annual limit of 1 million. 3/12 of 1 million would be just £250,000, i.e. £250,000. And that expenditure is more than that. So we'll take our 4 possible AIA. It will still leave a balance to go into. It's just plant and machinery. So that will be into a main pool computation. And in that main pool, we can then claim WDA. But again, whether it's AIA, whether it's WDA, we need to time apportion. So on your main pool, it'll only be 3/12 of the annual writing down allowance that will be available to you. Let's just look at how those numbers pan out now in the answer. 12 months to, so about that typing error. Again, depending on when you are looking at this lecture, that may have been, hopefully will have been amended for you. But it should be the 12 months, of course, to March 20, as per the information in the question. No written down value brought forward on the main pool, but we're going to need a main pool in the second accounting period. Firstly, the additions qualifying for AIA. We get a full AIA. There's your capital allowance for the opening period. Well, the 12-month period there, 68,000. Gets somewhat more interesting in the short period, the 3 months to June 20, where additions qualifying for AIA amounted to 277,500, but we know that we must limit our AIA to a maximum 3/12 of that 1 million, as it is a 3-month accounting period. That is 250,000 that immediately goes into the allowances column. That leaves a balance of 27,500. Nothing to add it to, of course, because we had no written down value brought forward at the start of this period. The writing down allowance on a main pool is 18% per annum, but we've only got a 3-month accounting period, so we take 3/12 of that. Again, put that through your calculator. Hopefully it will come out to this figure. That goes into the allowances column and, of course, is deducted in deriving the tax written down value to carry forward there. Get your total allowances for the period. That appears to be 251,238. And bring that back up to here and put it into your corporate tax computation. If you take those capital allowances away from your adjusted profit figures, you've got your tax adjusted trading profit. We've already dealt with capital gains and donations there, and therefore you can get your TTPs, tax at 19%, and you get your corporation tax liabilities accordingly. Okay, long period of account is just systematic working using a 2-column presentation format here on the right-hand side of your page, with first of all the 12-month period, second the balance of the period of account, here a 3-month accounting period. Again, probably in an exam question, you have to work out that adjusted profit. That would be referenced to a working. The capital allowances are always going to have to be referenced to a working. Chargeable gains, you don't yet know how to do it, but you may have been required to calculate that chargeable gain there, as well as merely allocating it to the relevant accounting period. Any qualifying charitable donations paid in the period will be identified clearly within the question. You simply need to allocate them. What we could have had, of course, is property income and or interest income, where again, two separate accounting periods. What was accrued for the 12-month, what was accrued for the 3-month period. If again you couldn't get an accrual, they didn't tell you any accrued amount or the ability to compute it at the end of the 12-month period, then you simply get what it is for here, the period of account, 15 months, and then just assume it accrues evenly, 12/15, 3/15 accordingly. Okay, that therefore sorts out the long period of account. So now, whatever length of statement of profit or loss they may give you within the question, we should know how to prepare either one, or in this circumstance, two corporate tax computations to establish TTP and, if necessary, if required, to compute the corporation tax liability thereon. But of course, in a real-life situation, it isn't always the case that companies, businesses, here corporate tax, so companies, make profits. And as we saw with the unincorporated trader, if the trader made losses, there was a variety of different trading loss reliefs that may be claimed. It is that situation again now in corporate tax, where we have our own separate rules for corporate tax, and we, in our next chapter together, on chapter 18, will be able to go through those different types of loss relief and see how they apply. Remember from your income tax studies that if you have a trading loss, or indeed as we saw in chapter 16, a property income loss, the assessment to record on the computation is nil. And we separately then identify, in the case of trading losses, which reliefs are available, and of the reliefs that are available, we then select the loss reliefs that will use that loss in the most efficient way. And many, not all, but many of the objectives that we strove to achieve to get the best use out of trading losses for the unincorporated trader will hold true here also in terms of the incorporated trader. But that awaits us in our next lecture together.